Episode 80 of Topline, the best go-to-market podcast in the land. It's me, Sam Jacobs, CEO Pavilion, Asad, CEO Sales Talent Agency, AJ Bruno, CEO of QuotaPath, and we're joined by friend of the pod, legendary investment banker turned entrepreneur, former. But it's like my dad says, you're not a former Heisman Trophy winner. You're always a Heisman Trophy winner. We can... Anyway, it's David Spitz, everybody. It's the pioneer of bench sites. It is the purveyor of the best benchmarking data in SaaS. The inventor of the Pacific Crest Research Survey, friend of David Skock, the man that took Google public. Is that true? I just made that one up.
No, you're exaggerating now.
Salesforce, HubSpot, ServiceNow. Yeah. So quite a few.
You were part of the Salesforce IPO?
Well, I was until my firm got sold, and then we couldn't be there because we didn't exist anymore.
David, we need to teach you about storytelling and narrative.
I was a yes. Yes, I was part of it.
Okay, let me revise that answer. Yes, I was part of it.
I held Mark Benioff's hand as he went, and he said,
also, little known fact, David invented the semicolon. Welcome to Topline, the podcast for the best founders, operators, and investors in B2B tech. Every week, AJ Bruno, Asad Zaman, and me, Sam Jacobs, will break down what's important for you to know to be the most well-informed professionals in the market.
This episode is brought to you by Bizzabo, the go-to solution for managing B2B conferences and events. Plan, promote, and produce events that engage your audience and drive revenue, all from one easy-to-use platform. Learn more at bizzabo.com. That's bizzabo.com.
All right, so we're all here, David. We are a follower of your insights and expertise, and there's a conversation. I think Asad will kick us off, but there's a new. Would you say that you pioneered? Did you and Jocko together create the metric GTM efficiency?
Well, there's a lot Jocko and I do together, but that's one that I did myself, actually.
Oh, cool, great. Yeah. So that's what we're going to be talking about because recently on social media, David said that I whiffed my analysis of the impact of the metric, and you made some good points. And so I think it's going to be a great conversation because I think the big headline is that GTM efficiency across the basket of companies that you cover seems to be deteriorating. And I want to know, and we should talk about what that means. But Asad, I've sort of stolen your thunder. Asad, would you like to say anything else as we embark on episode 80 of Topline?
Thank you for giving my thunder back to me. I guess the framing question is that before we jump into what does it tell us and how to use it, just quickly, if you can frame, why did you even bother coming up with it?
Good question.
Yeah, why did you bother coming up with this? We had all these metrics already. Why did you think we needed a new one? What led you to the creation of it, and what is it?
Yeah. Thank you for having me on, by the way. You know, that LinkedIn post was a sneaky way to get on the podcast.
We wanted to have you on for a while. You're a very smart person and a nice guy. And a good namer of children.
Good namer of children.
One of his kids is named Sam. So
I was thinking of you when we did that.
If Jews had godfathers.
So, Asad, that is a great question to start with, which is like, why? Like, who needs another metric? There's so many of them. And I think, this could be a long story. I'll try to keep it short, but I think everybody has known now for a few years that like the world of go-to-market's going to crap, right? It's been ugly. Like it's been ugly to live it. It's been ugly to watch it. And there's some metrics that are obviously going to crap. I mean, the most obvious of which is growth. But I think there was this story that was being told, at least in 2022 and then the first part of 2023, which is like, yeah, growth sucks now, and we all know why, because we have this hangover from 2021, and capital's not free anymore, all that good stuff. But the other side of this was, but everyone's getting more efficient. Like, so it's okay. Like, it's getting different and it's getting better, and we're all going to, latch onto this, and money's not free anymore and everyone's getting more efficient. See, look at free cash flow. It's going up. And see, look, sales and marketing expense, it's going down. Everyone's doing what they're supposed to do. There's more work to be done, but we're on the right track. Mm-hmm. And I was looking at all this and saying, I don't feel like we're on the right track. And by the way, I'm not a go-to-market person, as Sam said. And you all know this. Like, I've sold stuff, but selling an IPO is quite different than selling software. Let me tell you. So I don't have the remedies here. That's why I link up with people like you and Jocko and others. But I'm pretty good at numbers, and especially when the numbers have dollars in them. So finance. And I was just looking at this and I'm like, there's something that's not being told here, or people are telling themselves a story that's just not very helpful. And when you think about go-to-market, of course, you think about the sales and marketing expense. And there was just like, it kind of dawned on me, that was probably about a year and a half ago, when I'm just scratching my head trying to build a LinkedIn profile and trying to, build a voice. And I'm like, the thing to compare is like what you're spending versus what you're getting, right? And what you're getting is not your total revenues or your total ARR. What you're getting in any particular period is the change in that number, whatever you were able to add by selling, of course, selling to your existing base through upsells, selling to new customers, and selling in the form of like retaining customers. So you're doing things there too. But what you really should compare, quite simply, and I hate compound metrics, and this is a bit of a compound metric, but it's like not the god-awful LTV to CAC, which I mostly despise, actually. Love it in concept, hate it in practice. But this is, at least a simple thing we can all latch onto, which is like, well, what did we spend? And don't look at just a quarter, because a quarter can just move all around and the sales cycles are long and everything else. Look at a long enough period of time, like a year back in any particular point in time, and see what you spent overall and see what you got, which is the net change in ARR. So there's a lot.
David, just to be clear on that, look back, is that a rolling number? Is that an aggregate, an average?
It's rolling. So the first handicap we all have in trying to do this for the world, not your own company where you're on the inside, but if you're looking at the public companies, luckily there are enough of them now. There are about 80 public SaaS companies. They don't give you everything, but they do, pretty close to giving you they give you revenues, and you can kind of infer what ARR is from that, and you can see how it changed. So yeah, look back a full year. They report every quarter. Don't just look back in the most recent quarter, and you can see what they spent in the last year, and then do it across all the 80 companies. And so that was like my hypothesis of like, well, we should look at this. I wonder what it's done. I bet it's pretty crappy.
And so if you look at this and you look back and you say, let's look at...
Hold on, Asad. Let's let him finish the definition, if that's okay, so that people understand exactly what it is.
I'm basically done. I think Asad, I'm basically done. So look back, but importantly, like, see what it is like today. So today you would look back to the June quarter, and you would look back for the 12 months into June. And then do that like every quarter as you go forward, but also look back every quarter. So we have the numbers going back. We can see what it looked like last year. We can see what it looked like for calendar year 2021. It looked pretty, people were pretty healthy then. But we can look back as far as we want. And when you plot that, which is what I've been doing, it is an ugly line. Now, higher is worse. This is where some people are like, wait a minute, that's not go-to-market efficiency. That's go-to-market inefficiency. I've never claimed to be a great namer of things. And the name sort of got away.
Except children.
Except children. Yeah, my firstborn. But anyway, if you look back over time, and I know, Sam, you were dealing with the paper, but you're like, hey, it's only 5 or 6 quarters, and I need to see this over time. Well, in fact, the metric is over time every time you plot it. So you have that going for you. But also, and this wasn't in Jocko's paper, to be fair, and I put it in the comment that, yeah, you're right. Like, maybe you didn't whiff. Maybe it was just foul ball. So But anyway, if you look back, I look back so far to 5 years, 2019, and it's just gotten worse every single period.
And just for everybody out there, it's just simple sales and marketing expense over net change in ARR across 80 public SaaS companies.
That's right. It's the median, but the way to say it and think about it is like, how much did it cost? How many dollars did you spend in the last year? And then what did you get for those dollars in terms of increased ARR, which obviously is the goal.
So, David, you said I whiffed. So we'll go to my whiff.
Yeah, we also gave you. I think we gave you a double in the comments, but nobody reads the.
I mean, I gave myself a double. I'm pretty sure, and that.
That could be,
unsurprising.
But the comment was right. I actually, because I did this math, and I think it was really interesting. We were terrible 2 years ago. It was like 4 to 1. It was 400%, and it's gone down to 2. I think 2.1 or something. And it's actually, I just did the math again, and for this quarter on the rolling, and it's gotten even more inefficient.
You did it for the whole year?
Efficient. Yeah. Yes, for the whole year. Exactly.
I was like, oh boy.
Inefficient is the right terminology here, Asad. He told us it's inefficient.
So you got more inefficient or efficient?
No, I got more efficient. His naming, I was making a joke about the naming convention. Come on. More efficient, but I said that's pretty good. And I think your comment was related to like, what does good mean, right?
Yeah. Well, we can talk about that. But first of all, like one of the things that you should be thinking about, and this is like a benchmarking thing, like what is good and what is bad, like you or mediocre, or whatever you want to call it. On the one hand, like compare yourself with others, right? And where they're at, and make sure they're comparable companies, companies that are selling into similar markets. So you can kind of, of course, if you're in a market where there aren't that many players, it's a little harder to do. But then also compare yourself with yourself like a year ago, 2 years ago. Like that's probably the one I should have put first. Like, what's the trend? Where is it going? And so you can't really say on a complete absolute basis that like $2.50 of sales and marketing per net new ARR is like definitionally bad or definitionally good. Obviously, lower is better. We all no one's going to dispute that. But the thing is, we know that if it was $1.50 2 years ago and it's $2.50 now, like that's not good. Like things are going the wrong way.
I actually have a question.
Let me add one more point to it, and then I'll stop aside because this is really important because this came up in our back and forth, AJ, which was, you were like 250. Is that maybe that's not so bad for me because we're growing faster. And indeed, like if you're a younger company and you're growing faster, it's less about how fast you're growing and more about how much you're leaning into new customer acquisition. Because everybody knows that it costs a lot more to acquire $1 of new ARR from a brand new customer, right? I mean, that's just a given than it does to upsell. At least it should be that way. Of course, if you're struggling, as many are right now, people are spending a lot of money on upselling. And that's one of the big parts of the problem. So when we start breaking this down, which I'm sure we'll do in a minute, it has a lot to do with breaking it down, which I know Sam was eagerly asking about in that episode a few weeks ago.
Well, the $1 trillion question is, you said comparison. I'm sitting here looking at this metric. I have a board meeting next week.
Uh-oh.
When do people start putting go-to-market efficiency on their board decks? And do investors start asking for this? And you went through this with 4 entrepreneurs, like the godfather of SaaS, whatever. But a lot of those metrics are metrics that you worked on in the background, and then they started to become commonplace. Did you see investors start to ask for them, or did you see founders start to put them on board decks?
Well, I mean, and those were like a long time ago. Those days, who knows how the hell it happened? But it did happen. That people started to look at. I'm not going to claim I invented NRR. I mean, a lot of this is groupthink. There's some other great people out there who are doing stuff, but I think there have been go-to-market efficiency metrics of other sorts around for years. And I happen to like some a lot better than others. Like I've already talked about that LTV to CAC. It's problematic. We can come back to that. But the thing to do with this metric, because, and let me get to your question by sort of answering something that Sam posed before, which is like, what do I do about it? Like, how do I deal with this? Like, it's all fine and good, David, but like, I don't know how to, you're not giving me a recipe for success. Of course, I say, well, talk to Jocko or talk to others in his business because he knows more about that. But I'm not ready to hand that off to him yet, because the big thing to do is to break it down. So with the public companies, you cannot break it down. They don't tell you what the gross churn is. You need that number. But you also need to understand, like, well, of the business that you did get, the increases that you got, break those down for me. So if, let's say, you grew by 100 million, big company, let's say, and 80 million of it came from new logos and 20 from upsells, that's a very different story and a different picture. And it's going to have a higher cost than if it were the other way around and 80 of the 20 came from upsells. In the first case, it's going to be fine, or more fine, to have that cost be somewhat higher, because everybody knows it costs more to get those new customers. But guess what? If your product is good and sticky and tending to both renew and upsell, like, that's good. That's a great investment. That's why people, do expect to spend more than $1. And by all means, you should spend a lot more than $1 if you're getting really sticky customers who are very liable to be upsold quite a bit over the next few years. That's well worth it. And so the thing to bring into your board deck, yes, you should have this high level metric, because it's something that's quite credible now, because you can look at it in the public markets. But you, as a next order of business, you should break out, like, well, here's what we got from new, and here's what we paid for that. So you're gonna have to break up your sales and marketing expense and say, like, here's the amount we used for new customer acquisition, here's what we used for upsells, and here's what we think we're spending for renewals, which might be a customer success type metric.
And may I posit something?
Yeah.
So is it possible, to your point, one of the things that I teach in CRO school is that there's a series of fundamental assumptions about SaaS. And like the biggest sort of human psychological assumption is that it's expensive to change someone's mind, which is high customer acquisition cost, but it's cheap to keep their mind fixed where you changed it to, which is low cost of service. And to your point, if there's a disproportionate amount of that money going into upsells, and maybe you're even beginning to compensate account managers or CSMs like salespeople, you start to break the fundamental math behind SaaS, which is we're willing to spend a lot to acquire a customer because it's cheap to keep them around. But if it's not cheap to keep them around, then it all begins to look like a services business or a transactional business. And is it possible that this increasing or the deterioration of GTM efficiency is in some ways a function of every product's lack of stickiness, which is another way of saying people are just changing their mind more often than they had in the past? Is that a possible explanation?
I'm sure that is a part of it, but I don't think that's all of it. Like, I think a lot of the deteriorating go-to-market efficiency has to do with the fact that there's just not as much demand out there anymore. I'm not the only one who's been saying this. Or
there's too much noise. I mean, there's
a lot of noise, but there's also like there's less demand for a lot of these products. I mean, not ChatGPT. There's plenty of demand for that, right? There's exceptions for sure. But there's less demand, like growth is lower, but we have not pivoted to lower spending, which is almost a necessity if you can't get the growth. If your product is really good, but there's just not enough demand, that you're not going to change that equation other than by reducing.
I mean, headcount is a function of spend. So you reduce, sure. I mean, reduction in headcount, which is, we have seen that.
We've seen that, but I don't want to argue for lots of headcount reduction. That's not very popular, but I don't think we've seen enough. If this is where the growth is going to end up, I don't think we're going to see enough. And again, like you only get clues from the public markets in a particular case, because they don't open the kimono for you. But if you're running a private company, you can do the math, do that next level math that I just explained, and you'll see it. And here's the thing that is baffling to me when I look at specific. So it's one thing to look at the medians and just sort of wave your hands at it and pontificate. People like that, but at a certain point, you get people like Sam who are like, yeah, but wait, like, hold on, what do we do, and what does it mean? And
I love your impression of Sam, by the way. That was a great impression.
I think he does. So I was looking at one company.
I've seen more offensive impressions.
You have to get further into the podcast. So, I was looking at Smartsheet. This is a company that just got acquired by, or is about to get acquired by private equity, Vista, I think.
Yeah.
And the numbers, I'll get these slightly wrong, but they're roughly right. Like I think their NRR was 116% last calendar year. But they're growing like 17%. So the first thing, and we don't know like the breakdown, but you can kind of assume that if NRR is 116%, that the base is growing 16%. Now that's probably not right, because that would mean they only got 1% of their growth from new customers, which doesn't make any sense, right? So something's wrong there, but let's just assume it's close enough. So they didn't have a lot of growth from the new, and yet they're spending, their go-to-market efficiency or inefficiency metric is like $3.25. Where the hell are they spending that money? Like, I'm sure that they're like, my guess is their GRR is a lot tougher than it looks. Yeah. Like, so they're probably spending a lot of money just trying to upsell against some real churn that's
I'm about to send all the Vista partners a message, by the way, right now. You all need to talk to David Spitz and do your diligence.
Well, I'm sure they looked at this. I know that many of those people, and, we know what they're going to do, right?
Yeah, like, on the other side of it.
Mystery there.
What? PEs? But they always have they never have the same playbook. They're always like really culture and cuddly, and they're super friendly to the acquiring companies, David. They're great.
There are multiple PE playbooks, though. Like, there's the roll-up, which is less aggressive than buy it to cut it up. Like, we're not in the 70s and 80s.
To be fair to Vista, they've actually done a really good job.
They've done a lot of roll-ups. Yeah. Like, listen, barbarians at the gate, sure. Like, you would buy a company, cut it up, make money, even though the company would go bankrupt. Sure, those things existed, but the industry has evolved. David, I have a couple of questions. So, when you started talking about it, you said, we have seen companies that are growing less, but they have at the P&L level become more efficient.
Yeah.
Right? They have more free cash flow margin and actual free cash flow. So why is this such a big problem then? If let's say for an organization that was growing from a 0% interest rate environment to one where almost in the snap of a finger, it became a 5% interest rate, the cost of capital changed so much, the demand situation deteriorated so much, these companies being able to deliver the efficiency at the P&L level, one would argue that they still navigated the situation well. They minimized risk at the P&L level, but yes, they had this one team that is the team that deals with growth and demand and all of these things that had to take some hits on the chin. And yes, they went from, let's say, $1.50 to $2.50. But what's to say that that's not what good looks like when the interest rate changes from 0% to 5%? Maybe where they got to is what excellent looks like in a downturn.
As long as you think 6 times ARR is excellent, maybe that's true. But most people think that, right? Like, I'm being somewhat facetious here, but not really, right? I think... Again, we're talking medians, but you can pick a company that's going to be at the median. You're going to see the free cash flow margins like mid-teens now, 15, 16%. Yeah. Growth is similar, a little bit higher. So we're at
16, 17. Yeah.
I don't think anybody's going to look at the sales and marketing to net new ARR and say, that makes sense. Let's keep doing that.
But they're not saying that. But that's the argument is that they're not saying, let's keep doing this. What they're saying is, okay, guys, 10 years was party time, 0% interest rate. There was hardly any competition. A lot has changed. The number of technologies per department has grown substantially. So from 2021 to 2022, the average number of apps per team in a company, and I think this is public companies, was 64. It had grown 41%. Between 22 and 23, it became 73. It grew 14%. The interest rate has gone up from 0% to 5%. And the number of tech companies in the ecosystem has been growing at 7% per quarter, meaning that from 2020 till 2022, there were almost twice as many companies out there fighting this fight. And so when you're going from a really glorious market into this murky period, you're not saying that let's just keep doing what it's going to be in that moment in time. It's like, how do we get through this period? How do we get through 2021 to 2023, come out of it, and then we'll be able to do different things at that point once interest rates start coming down and the demand situation gets better. So it's not keep doing it. It's more like survival. For survival, does 250 look okay, is what they would argue.
Oh, for survival, I would say, but I think we're past that point of like survival or not survival. I think it's
last year was survival, like for these companies.
These companies are surviving. I mean, most of them, the public ones at least. I mean, the private world's a little bit different, especially as you get to smaller companies who maybe can't raise money. But these companies will survive, but they'll also get taken out because they're just not, there's just an opportunity there. Like Smartsheet can look like a whole lot more valuable company in the hands of someone who's willing to do what's really hard to do in the public markets. But my point is, like you say, this is what excellent looks like. And there are a lot of things that I hedge on. As you're a banker, you sort of do that. But this one I don't hedge on. Like NFW, like, no, this is not what excellent looks like. Like,
not in a vacuum in that moment in time. Like, because one could argue if the cost of capital has gone from 0% to 5%, and this has just doubled in inefficiency at the median level, like maybe that's what was required. Because what is the opposite? Like Jocko in his paper wrote that companies are doing this because they're still holding on to growth at all costs strategies. And I would highly disagree with that. I don't think insane people operate public companies. Like I'm sure there's a quality dispersion there, but like most people are thoughtful and intelligent and trying to do a good job. And I don't think that they're trying to do what they were doing in 2020 and 2021 in 22 and 23. They're trying to get through the period. Now, if one of the biggest costs for them, there's two parts of this. A, the same company could say, I'm making investments today because I believe this is possible. It's a hypothesis. It's a bet. Like that's why we don't pick particular stocks and we bet in the entire index because it's hard to make these type of bets. But as a company, you have to. So you make this bet. You're like, I can grow by this %. Let's make these investments. It's more conservative than we've grown in the last 5 years, but we think we got this. Now, if you got this and you achieve it, you look very efficient. And if you don't achieve it, you look highly inefficient. And so a lot of it is like setting a target and missing the target, but it's still a more conservative target than they'd had in previous markets. That's one. Number two is a lot of this cost is headcount based. So I think there is a signal that is quite aggressive to the public markets when you take down your headcount and go to market by 50, 60%. So it's like you kind of have to take this inefficiency a little bit because the other moves might hurt your stock more than this.
It's turning a really large boat. It's hard to do. But if growth ain't coming back to high, you got to look at a particular company rather than the medians. You could argue Salesforce is doing the right thing given who they are, but they're a special case. Growing only 8%, but they're generating 30 some odd % free cash flow, which is a lot of free cash flow. But a lot of these companies that are in the middle of the public markets, it's going to take quarters to do, and some of them are going to hope and pray, as many have, that like they will get taken out so they can take those moves. Because if you're sitting as a public company, you're right, like you said this a few weeks ago, they can't just like cut to shreds their sales and marketing. But arguably that's what a lot of them will need to do. Maybe it takes a few extra quarters if they have to remain public, or maybe there is some deus ex machina where you can go out and apply AI to what you're doing.
Why do you think growth is slowing, David? Like, is it just economic? Is it just cyclical?
I don't think it's interest rates. Like, I think we're past that point of suspecting it's that way. I mean, if you think it's interest rates and you think that if more money were pumped into the venture world, first of all, I don't really subscribe to that. Like a little bit more will, but I don't think we're gonna like see these decreases in rates somehow fuel like lots of new startups that aren't like the kind that we're seeing already in the AI universe. So I think that I don't really know. Like that's sort of like a higher order question. Like I get it when I look at the go-to-market space, like a Zoom Info. Like I think we can all understand why growth isn't what it used to be for Zoom Info. If you were selling to a lot of startups and there's just less of them now, or they don't have money, I get that. But why
There's
is
also
growth
like
slowing
12
for?
Go ahead. No, go ahead.
Yeah, why is it slowing for some vertical market SaaS company or whatever? I can't completely put my finger on it. I think partly it's what Asad was saying before. There's so much competition out there now, just given how many companies have formed. There are always going to be some areas where you're going to find a company that really is doing well, and
Yeah,
we'll
isn't it
see more
fun?
of those. We've seen a few IPOs that have come in that kind of fit that, like a OneStream and a Rubric and a
Is great.
Klaviyo. But those are the exceptions. To grow 30-40% like at scale, there's just so few of those now.
Today's business landscape is full of uncertainty, and succeeding as a go-to-market leader has never been more challenging. Pavilion is here to provide you with the education, support, and resources you need to grow, learn, and unlock your full potential. Join more than 10,000 of the world's leading go-to-market executives in a private membership community designed specifically to fuel your success. Visit joinpavilion.com and use the code Topline20 to get 20% off your membership. That's joinpavilion.com, and the code is Topline20 to get 20% off your Pavilion membership. And now, back to the show.
David, I actually like a lot of what you're saying. I mean, it's just a couple of data points. A friend's company was acquired by a public company last year, and he was a PLG, product-led growth leader, just crushed it on the efficiency gain when it came to go-to-market. And the acquiring company, big public company, had a classic slow-moving B2B SaaS business, and he was beside himself. It was like, dude, this is bananas. And he left that company just a couple months ago, a year after their acquisition. Guess what they still had? A slow-moving B2B VP of sales, CRO, SaaS business, and hadn't made that change. And then when you're a public company, you can move boxes around. You can shift them. You're doing some work that's a little more interesting. I would be curious to see if looked at these public numbers, the go-to-market efficiency numbers 10 years ago, and what they looked like then from some of the 10Ks and
yeah, I haven't gone back that far, although it's doable. I went back 5 years, and I do want to extend it further back, but there's a lot of issues with trying to do that. There's fewer companies, and you're comparing apples and oranges. Those companies were smaller, so they were growing faster. And of course, growing, if you grow fast, like you're going to start looking, these numbers are going to start looking pretty good, unless you're spending like 80% of revenues on sales and marketing, which some people did back in the early days, of course.
I guess I think of it as a combination of three things. The interest rate went up. The amount of technologies that were integrated in each department increased substantially, leaving less room for more because companies were dealing with tech bloat and the inefficiencies of tech bloat, because there comes a point at which they're depreciating returns of another piece of technology, even if it on its own in a vacuum, it's a beautiful piece of technology that can promise great efficiencies. And then the third is just the intense competition now for dollars, for attention, for all of those things. And so I think this chart, it's really interesting because it kind of paints the picture of what we know was happening, which was go-to-market just got a lot harder. I think when you look out into the future, there doesn't seem to be a lot of signal that it's going to get all that much better. This might be a chart that is continuing to show worsening signals because sure, interest rates come down, and I do think they make the demand environment better for some, and quite substantially for others, and then for some it might not be that consequential. But the competition doesn't change. The tech bloat situation doesn't change. And so
the competition and the tech bloat would change because I think we just need to look at the right time horizon potentially. Like it just might be that these are 10 to 15 year cycles as opposed to what we're used to, which is like 3 to 4 year cycles. because over 10 years, the competition will change because a bunch of companies will go out of business.
Yeah.
You know, it's like everybody ate, they're full, and everybody's like, okay, we're so, you know, when's everybody going to be famished again? It's like, well, it's going to take a while for this all to run through the system. And I think the thing that I think about is the problem is that, like, this assumption, and I mean, I think the assumptions are changing in real time, but that SaaS specifically, like, this business model needs to wait, because it might be true that things do come back. They just come back in a different articulation, a different formation.
Yeah.
If they come back in a way where it's not really SaaS, it's consumption-based pricing, it's an always-on CRM that isn't
SaaS
Salesforce
too, by the way, but that's another debate you could have. But I
SaaS?
think the idea that you're going to pay for what you're getting and be metered, whether it's a subscription or by usage, I mean, either way, it's software as a service. There's nothing.
I guess, I mean, recurring revenue, highly predictable.
That
recurring
would still be recurring too, right? I think Snowflake is recurring. Even though, you know, people pay as much as they eat.
Or is it reoccurring? Like, you know, there's that conversation around recurring versus reoccurring, because there is a nuance, there is a difference to consumption versus. We've got the example of Snowflake, which is extreme product market fit plus usage-based pricing.
Right. I think that one important thing about Snowflake is they report these 180% NRRs, and it is exactly what we're all saying, which is it's not
consumption.
It's not increases in the fixed baseline of subscription revenue. It's just people eating more, and if they ever ate less, which it sort of like impacts the viability of that definition of NRR. If it's like, well, it fluctuates based on usage, it's like, well, okay, that's not quite what I thought we all meant, but nobody says that when they talk about Snowflake. Anyway, back to you, Asad.
That's why it went from like 170 to 117 right now. I think they're still the highest in the public markets out of these tech companies. I believe last time I checked.
One of the higher ones, yeah.
One of the higher ones.
117.
I think last quarter was 117%, which is still great, but it is a very different model. So I think what will be interesting to see is what revenue dynamics we see in a company that doesn't have extreme product market fit and consumption-based pricing. Like, that revenue is going to come across as a lot more volatile for companies that are searching for product market fit, that are evolving the solution and trying to enhance it. And so that might be more of that. The volatility of that revenue does change our perception of these companies compared to how we thought of recurring revenue, which was very secure. Like, the base of revenue is super secure, and then you build on top of it. How would this look in a consumption-based organization? Inefficiency or efficiency? Is there a nuanced difference as to how we should read this metric if we're analyzing a company that is consumption-based versus one that was traditional seat-based pricing?
I think I love consumption-based pricing mostly because it's where I think the world absolutely has to go. When you think about AI and how that's going to change the way people consume services and product, there are going to be a lot more AI agents doing work. And so if you're a vendor and you're just selling subscriptions based on seats, like you're fucked over time. I mean, there are probably a few exceptions, but so I think we all have to just come to grips with the idea that the world is going this way. Whether there should be a different name for NRR in a consumption-based pricing world, I mean, that's a definitional thing, not my forte, right? But measuring like how much things moved in that way from your existing base, critical. Like, call it whatever the hell you want, but we all need to track that. But let me and if you're at a consumption-based pricing or usage-based pricing company, you have to be a hell of a lot more agile in lots of different ways, but especially in your go-to-market. You're going to have to figure out how to scale up and down. And I'm not the person to tell you how that gets done, because, like I said, I've not managed go-to-market myself. But
which is just like fundamentally really hard to do, because you're talking about most of the costs being human beings. And so you're like, okay, how do you make human beings more flexible? And it's like, okay, maybe you have contractors, but salespeople on contract, that doesn't really work. I would think that's a way to fail at trying.
No, David. Adaptable commissions.
Adaptable commissions. That's what I meant.
So you having humans being your main cost makes it very difficult to scale up and scale down as things evolve, which means that how we view these businesses might change because they're just more volatile businesses now. Like there was a stable period in SaaS when competition was low enough and interest rates were low enough and the model was really nice and provided this stability and we could give it these multiples, and maybe there's just going to be a changing of guard to.
But isn't that the elephant in the room, Asad? That you said there's three things, and you said interest rate and demand, or for demand going down, interest rates, competitive noise, and wasn't it just maybe everybody's just sitting there and waiting to see what's going to happen with AI and doesn't want to make any decisions on demand side anywhere, and they're just like pausing. They're trying to figure out how to commercialize this, and we're like, demand's going to zero because we need to figure out this play, and we don't, and people are telling us to make this play, but we don't know.
Yeah, there's a lot of that for sure. But this is like, on some level, this is really, really simple. Like just zooming out on this whole conversation. The SaaS industry has been built on the premise that companies at some level of scale are going to grow really fast in a recurring manner, like with recurring revenues. And by really fast, like obviously it has different meanings depending on how big you are. But if you're, I don't know,
triple, double.
Well, forget. I never fully subscribed to all of that. Like that stuff was crazy. Like I would roll my eyes at that. But obviously, some companies did that. Hallelujah. But I'm just talking about companies that are, a few hundred million in revenues, growing 30-40% a year, and these companies, this whole industry, and especially the way go-to-market works, has been built around that premise. And those economics kind of worked, not just because the capital kept coming in, and that certainly helped, but even companies that were self-sustaining, companies that really always were, reasonably efficient on the free cash flow line, were built for that kind of growth. And where they could continue to get a lot of new customers, so they would play that LTV to CAC card, and they would convince people to do it. That ain't there anymore for most companies. Now, maybe, yes, if you're ChatGPT, by all means, that is frickin' there right now. And I couldn't believe, I was reading a story in The Information the other day just saying like, oh God, it's so awful. They're burning so much money. No, it's not. Like who could have imagined that they would?
That's the most
Google, and I mean,
that's the fairest valuation for an AI company you will find in the world today. 12 times revenue for OpenAI. Like
they're forecasting 12 times next year. They'd have to hit it, and they have.
But most companies' valuations on next 12 months revenue. Like most of these valuations we see in the market is NTM, right? So
what's that forecasted revenue look like in the next 12 months right now?
11 billion.
That's so nuts to me. Who does that pass? That
12 something.
That's like, what is Shopify's? Like they're getting up there. Like they're gonna.
HubSpot is 2.
I know HubSpot's 2.
Yeah, and look at how like big.
That's crazy. That's crazy.
Yeah, like I was thinking about this over the weekend. I was like, that's probably Australia's P&L for Salesforce, right? And so they really they punch above their weight.
But
what a low blow! What a rare insult! Asad just
let's contextualize. I think this is almost part of the point of the conversation. How old? Listen, you can say that SaaS is. When did Salesforce go public? Like 2003, 2002, or something. Yeah, so
20 years.
Okay, so it's been 20 years, and maybe the golden age of SaaS has really been like the last 10 years. And to your point about LTV to CAC, David, we're saying all of a sudden this industry model, some portion of which vendors were saying, and like software companies were saying, like we've got 7-8 year LTVs. It's like the entire industry is basically, it's not over, but it's going through this seismic restructuring and reordering, and that. What does that mean for how much any of these companies are worth? Because what it means is that like the world is so much less predictable. So like, sure, OpenAI can go to 12 billion, they can go to 4 billion the year after that. Like easy come, easy go. And applying I just think like our fundamental understanding of valuation, the world might be much, much more volatile.
Yeah.
Like the more that you introduce, the beauty of recurring revenue is like you can invest against it. That's the whole point of LTV to CAC. Like I can lean into that growth because I have high confidence that I know it's going to happen in 3 or 4 years. And if all of a sudden what we're really collectively saying is like, we don't know what the F is going to happen at all over the next 4 or 5 years.
Exciting.
As AI like interacts with itself and the world becomes more volatile, it'll become even less predictable.
Yeah.
That's
kind of exciting because there will be a new world that we'll see play out, because all of us kind of saw this cloud shift, and we went from perpetual venture capital used to be called adventure capital when it started. There was this wild cottage industry that would fund these hardware type of businesses. Microsoft's first round, I think they had 17 million in revenue and were profitable when they raised their first venture round. Like, we've seen stuff evolve so much that licenses to cloud changed the game completely, because you had recurring revenue. That recurring revenue enabled people to invest in these businesses completely differently. So venture capital changed at that point. Even the average age of a go-to-market team came down because sales complexity came down. And now we're going to see this new shift into what is a more volatile type of company that's just less predictable. And so we don't know how these metrics are going to look like, and valuing businesses and trying to assess if they're doing well or not based on the past seems like a way to find ourselves in a really tricky situation. I personally think that this trend line of go-to-market efficiency is just going to get worse and worse. And I think while companies are going to see this trend line get worse, because when I ask people that are saying go-to-market's not doing well and here's the solution is always non-compelling. If one person says we need to be more aligned in the go-to-market team, that's our number one problem. The other person says we need to measure and monitor the KPIs and be more systematic. And it's like, sure, all of these things I think can help marginally. The problem is, I think, a lot bigger than that. And what we need to do is look at the businesses from a P&L perspective when you're operating them and see, well, if I can achieve for a startup, if your burn multiple is palatable while your go-to-market efficiency is getting worse, that just might be the way that you have to look at these companies. When you hear that, managing based on burn multiple and tolerating a worsening efficiency in your go-to-market team, do you think that's a very dangerous way to look at a business now?
Who are you asking, me?
Yeah.
Yeah. So the burn multiple, I don't think it's appropriate for companies over a certain size. Like, they should be making money. So I'll put that aside. Now, there's a whole bunch of companies, way more, that burn money, and they should. But you should only be burning money if you're leaning in heavily into the new customer acquisition as opposed to the upsells. And I think that's a big part of the problem right now, by the way, in the public company space. So I lost my train of thought here, but I think that one of the things, when you think back on the history in your preamble, you talked about that. One of the things that was absent in the software industry back even in 2005 and 6, there were hardly any private equity firms playing in the space, because there wasn't recurring revenue, and they don't want to buy stuff that doesn't have recurring revenue. And there was technology risk that they couldn't get their arms around. And all these firms like Vista and Toma started to really attack the space once they saw an opportunity and once you could borrow money in that way. I think that where we are now, and the other thing you said was well, people look at those recipes for fixing go-to-market and they say, that's not compelling to me. I scratch my head over that because I understand why it's hard. And if you're a public company, as we talked about earlier, why you maybe you can't do that as a public company. But if it's a good company, meaning they're not just treading water, selling like hell to kind of counteract low GRR, but if it's a great product and they have a great future with potentially AI helping, obviously that needs to be part of the story, then they need to fix this in the public market, or someone's going to fix it for them. Because if it's a good company, they are getting pinged, as they should be. So, these cleaner fish of the private equity firms are going to be out there finding the smart sheets of the world. And that's
isn't that a healthy
private market too?
That's a healthy ecosystem, though, because some companies will make this bet that, okay, I think every company knowingly had worsening go-to-market efficiency in the public markets. I don't think anyone was like, no, I think this will be fine. And then they were surprised by this. I think they all knew that, okay, this risk exists, but here's all these other variables that we have to take into account. And let's try to hit this number. If we hit this number, it'll be less worse. If we miss the number, it'll be pretty bad, but still better than if we went to the public markets and said, we're so pessimistic about our business that we fired 70% of our go-to-market team. We have great efficiency, but what's up? And I think you get killed in the market. So I think they knew what was going to play out or where that situation would trade. I think when you look at now, what's the calculus? Some are saying, I think the market will improve and it will give us a chance to pick growth back up. We have an opportunity to improve our product during this time. And so maybe we're going to attack an improving market with better products and activate growth again. Some are going to look at themselves and say, it's just not there yet. And PE is going to come and offer them a price and they're going to take it because they can't see the future anymore. It just got a little bit murky. They lost confidence. And that's an ecosystem that seems healthy because there's a way to take care of those companies, but there will be a subset to these companies that come out with better products. Salesforce would say that's what they're trying to do today, right? They're saying, okay, we got through this period. We're all in on AI agents. It's the future. It's going to be beautiful. We're going to reactivate growth. It's going to be fantastic. So I think there's going to be different scenarios based on whether you're able to improve the product situation and reactivate growth as the market improves.
Yeah, no, that's well said.
How's Salesforce stock doing right now?
Great. I've made 20% since it went down.
Yeah,
I bought it when it went down.
We just increased our spend with them $30,000, and it does feel like there's a platform consolidation play of like if they can incorporate AI functionality and productize it relatively quickly, even if it's not best in class, there's just a benefit to having all of your data and all of your operations in one place. We're seeing that personally.
Yeah.
David, I don't think we've ever had a more calming conversation about really scary stuff on this podcast. So I have to thank you for that. You have a very calming voice and these numbers are just, I don't know what's going to happen.
So I just think we are in this period. It's very, you still, I don't think the quote unquote ecosystem, like I just think startup land, I mean, it might come back better, it might come back different, but it's not business as usual. There's a lot of companies that are going to still go out of, there's still this massive reinvention that's happening. And I think there still seems to be like a lot of pain ahead.
Yeah. And I know I'm like the person who whines a lot online, but I'm fundamentally, and I try to say this once in a while, I'm fundamentally optimistic about businesses that have this model that sell technology in this way. As I said, I think it's going to move more where it adjusts and not seat-based subscription pricing, but that doesn't change it. If I think it's got to suck, like running one of these organizations where you're out of whack 500%, and having to make these kind of choices, whether you're public or private, like it's got to suck. But the thing is, if you do have a good base product and you're not dealing with lots of GRR, you have an immense opportunity. Hopefully, you can come into a situation where you're not sitting on a pile of preferred stock, and there are a lot of companies that have those issues to compound all these problems, and that's got to be. There's no recipe for that.
Well, there's tons of unicorns out there that were crazy valuations, and they're sitting there at their $20-30 million in revenue, and like that's like what happens to those companies? I have no idea. Yeah, there are recipes for success as an individual, but that's a very tough situation, and none of this is gonna fix those other issues.
What do you think is playing out at the late stage? Your life used to be focused on taking some of these companies public, and it seems like there's been like a real shift over there because companies used to go public earlier from a revenue perspective, and just from a P&L profile perspective, they used to look much just less mature than they have been looking over the last couple of years, post that ZERP period. And I was looking at some PitchBook data, and there's about $2 trillion worth of value that's stock that needs to go public, is what they were saying. You get different data points from different people, but I think the premise is that there are a lot of companies that are at that pre-IPO stage that are choosing not to go public right now for one reason or the other. The market, we won't get a good valuation because of interest rates and the implication on that. We can raise tons of capital at the late stage now. So if you open AI, like, do you want to be under the scrutiny of analysts? Why not just raise a bunch of money from Thrive, give secondaries, and have the flexibility to make decisions and operate your business without being in the public eye the same way? There seem to be like a lot of reasons for companies to not go public. How do you view this? Like, has that just changed now, or is it going to right size as interest rates come down, valuations go up, and stabilize at a higher rate?
This is pontificating, so waving, but I'll do a little bit of it. First, you gotta look at supply and demand, right? So, and it all starts with the valuations. You said it yourself, like the average company now is trading at 5 or 6 times AR. That's just not attractive to a lot of companies. Now, obviously, they're the one streams of the world that are of some size that are growing like astronomically relative to others. And so we've had a very few of those. We had like them and Rubrik. And there just aren't very many of those that are going to be able to get out and, now have a 10x revenue, forward revenue multiple. There's very few. There are some, Stripe, Databricks, but there's probably, you can count them on one hand of the ones that are like, clearly they can go public whenever the heck they want.
And they just don't want to. They're like, nah.
It's like, why? Huh? Like,
why would I?
Liquidity to their employees in lots of different ways. So they'll go public eventually, but they're in a class of their own. That's not going to fix the ills of this market. There's been a lot of speculation about, well, why isn't there a market again for companies that are, just a few $100 million, let alone like back in the heyday, in the early days, we were taking companies public that had 150 million in revenues.
Wow.
And we get some successful deals out of those. That's not happening again. The question is, are we going to get like a $200-300 million revenue company, 400? It's not a compelling proposition, and for most of these companies, especially if they're, like most of the ones that are already public, growing at 20-25% a year, which is, hats off to them. That's great, but that's not a recipe for like a stock that's going to trade well, let alone a deal that's big enough to attract the T-row prices and Fidelity.
I guess the interesting part is kind of what you said about Rubrik is a company that I really like, and they went public, but there are many Rubriks that stay private. You mentioned a couple of them: Stripe, Databricks, Wiz is another one, Deal, Rippling. These are companies that are ripping, right? Like, they're killing it. Their numbers look good, but they're still saying, no, I don't want to. And they're not really even saying that they want to do it next year. They're just like, I'm good. I much prefer it this way. And so it seems like before there was an opportunity to buy a growth stock that was a real growth stock. And that opportunity seems to have gone away for investors in the public market. And you find those opportunities in the private market. It seems like we're moving towards a world where by the time a company goes public, it looks more like an old guard type of company from a P&L profile perspective than what we used to like to invest in when these companies went public earlier on. And so you just think that's the way it's going to be now?
Oh, yeah. A lot's been said about that. I'm not entering new territory there. When you look at like how much value accrued to the public market investors in an Amazon or Google, like that, those days are, maybe there'll be one that, breaks the mold.
Well, we need to make it more attractive. We need to present to founders and CEOs and shareholders why it's better to be public. And if it's incredibly expensive and incredibly burdensome and it's not particularly compelling, all of the arguments I tend to hear from a lot of people that want the IPO market to come back are appeals to almost like morality. It's like, listen,
what are the incentives?
It's not so bad.
It's not.
It's a real challenge and a real honor to be one. It's like, okay, tell me how I'm going to make more money as a public company CEO. That's the argument that nobody.
It's tough because then there's some really big competition in all these funds that go headlong into it, including like the T-row prices of the world. Like they are putting money in these companies when they're private because they realized they were missing out on that value accretion. So
like this OpenAI round that just happens, wild. Like it's sixth largest venture round in the history of venture. I don't even know if you can call it venture anymore at that size and scale, but it's wild that companies can raise that type of money over and over again. Like if you look at Stripe and the fundraising they've done over the last year and a half, it's bananas.
I think and those companies are just extraordinary. I saw the statistic about Stripe. Their free cash flow is higher than every other public SaaS company except like two. Salesforce and I forget the other one. Maybe it was Adobe.
What?
They are number 3 in terms of the
free cash flow. Stripe.
Yeah. I mean, that makes sense. It's exactly what they do. Their payment process is literally generating cash.
Not just because, but they have an incredible business.
That's amazing. I would not have thought that.
Right.
Yeah.
I think what do you think of Sam Altman, Spitz?
I mean, you have to be impressed with what he's doing, but it's
he seems, I don't know, I don't trust him.
It's
you trust him, Asad?
There are a lot of questions. Yeah, no.
Why do I need to trust him?
Is there something recently? Did I miss something?
No, I don't know. It's the OpenAI mega round. All these people leaving. You need to trust him because he's the CEO of the company building the most important new technology in human history. So that might be a good reason to.
I think I actually believe in these guardrails that are in our society quite a lot. Like I think think about nuclear bombs. 30-something countries have nuclear. Pakistan has a nuclear bomb. Pakistan's a wild place, guys, and it has a nuclear bomb. It's had a nuclear bomb since the 1990s. And somehow we've all gotten together and not, blown the world up. And I think there are guardrails for really, really bad stuff that I kind of trust. And everything that's not really, really bad, I don't care. Like, it doesn't affect my life all that much. If he burns a bunch of people's capital, they'll learn some lessons and they'll still be fine. So I think the worst potential outcomes, I think I don't worry about those.
My guess, Sam, is less concerned about burning those investors' capital than he is with what the heck it's going to do to this society. I don't know. You tell me.
I don't like him. And without shout outs and wins of the week.
Who's going first?
Spitz, you go first. Shout out win of the week.
The what? Oh, shout out person of the week. Oh my God, I forgot.
Win of the week. Like,
oh my goodness.
Win at your company. It could be like, hey, I had a great coffee with Ray Reich, and gosh darn it, he knows a lot about. I love
Ray. I mean, Ray and I, even though we're overlapping, but I'm going to shout out to my team. And you mentioned Pakistan. Asad knows well. He's given me some counsel, but I have an unbelievable team in Pakistan who's in that coupled with Sam Altman, because I use AI. Like, shout out to my team, which I guess includes Sam Altman and his team, but especially my team in Pakistan.
Cool.
Brilliant. I'll go. We have Thanksgiving coming up on Monday. Wild that we do Thanksgiving at a different time than you guys, but it's a period where you reflect a little bit. And this is the one holiday where there's no religious tone to it, so I kind of like it the most. And I've only learned it since I came abroad. And it's a time where you get to reflect on your life a little bit. And so much has changed over the last, I think I've been abroad now for 17 years. 15 years ago, I remember taking food out of a garbage can and eating it. And now this is life. And it's fantastic what type of opportunity is available in the West. And for all its challenges, and I'm sure the US has tons, we have a bunch in Canada. It's still, these are the best places in the world to live. And I just feel very lucky to be here and be around the people that I'm around. So happy Thanksgiving to our Canadian listeners. And that's it.
Happy Thanksgiving. I'll go next. I am going to give a shout out to Ben Lamson. Ben has recently been named the CRO of a public company and one that's traded on NASDAQ called Bit Digital. But Ben has spent the last 10 years in Asheville. And half of his neighborhood was wiped out last week. His entire basement was flooded. They don't have flood insurance. He's had some definitely scary stories of what's going down in those mountain towns down in North Carolina. There's a lot of people, a lot of private people, they're getting a lot of help right now, which is great, but it's going to be years and maybe decades. And so just kind of wanted to give him a shout out because I talked to him. They got out to Michigan. They went to Michigan, where his family is from, He has 2 kids, and they're going to go back next week. But he's told me a little bit about the stories that working with neighbors, and just half of their neighborhood was completely wiped out, just houses gone. So thinking about them, thinking about all of Asheville and North Carolina, and then of course we have another one coming our way. So hopefully all of you all staying out of Milton's way and being safe in Tampa too.
Indeed. Well, if you're listening to this on Sunday, I don't know when Asad and AJ are arriving, but I'll be in Austin, Texas for GTM 2024, our biggest and best event ever for Pavilion. Susan Bird, Maddie Helwig, Jeremy Chaplin, Aaron Leader, Kathleen Booth. So many people contributed to this, what's going to be an incredible couple of days. We're doing our first ever sold out women's summit tomorrow on Monday. Then we're doing a 2-day conference for all of GTM. Jocko will be there. Sangram will be there. Kim Scott, author of Radical Candor, will be there. Benedict Evans, who was recently, who we interviewed, TBD on when we air that interview, will also be there. So just an incredible event. Thanks to everybody that's coming. It's going to be worth your time. We're so excited for what's going to happen over the next couple of days. And thanks for listening. It's been another great episode. David, thanks for joining us as our guest for a great conversation. We appreciate it.
Thanks, David.
Everybody follow David on LinkedIn. Click the little bell icon so you can get notified of his new posts and follow along as this business of ours evolves.
Bye, everyone.
Bye, everyone.
Thanks, guys.
This episode was brought to you by AirCall, the business communications intelligence platform. Deliver a better experience for your customers and your teams at AirCall. That's AIRCALL.io. Save time, save money, and improve performance with a single communications platform.
Thanks for listening to Topline. New episodes come out every Sunday. If you like what you heard today, subscribe so you never miss an episode, leave a 5-star review, and share it with your friends. Don't forget to join our Topline Slack channel to connect with us and discuss the topics we cover with other listeners. Click the link in the show notes. Lastly, if you're interested in joining Pavilion, you can learn more about membership at joinpavilion.com/membership. Thanks again for listening.